Hi. So by now you're already aware Bank of Canada did another rate cut today, September 4th, and that was 25 basis points. But you must be wondering how does it impact you actually? So in this video, we will explain you a couple of things, how it impacts a normal consumer, whether they are an existing homeowner with an existing mortgage, or let's say whether they are a prospective home buyer. So let's jump in. I will share a screen with you that will explain some differences, today's rate cut and yesterday's numbers. So here we go. So this first screen will basically show you, let's assume somebody already has a mortgage and the balance is $100,000 today. And let's say their interest rate was prime minus 0.90 yesterday, which would equate to 5.80 because prime was 6.7. Today, after the rate cut, the prime would be basically 6.45 minus 0.90, which was a customer's discount. It comes to 5.5. So let's say if these were the parameters, then the difference between these two numbers is basically roughly $15. So assuming this was a adjustable rate mortgage, not a static variable mortgage, but an adjustable one. Adjustable one means when the rate goes up, your payment goes down up, and the rate goes down, your payment goes down. So in a static, it does not change. The payments does not change. So this is an assumption. In case of an adjustable rate mortgage, your payment will go down by approximately $15. The bottom portion highlighted one is interest paid. So let's say this customer carries forward their $100,000 mortgage as is. Over the course of the term, they will be saving roughly $1,200 over the course of the term on a $100,000 mortgage. I know many less people would have a $100,000 mortgage, more balances actually. So this is just showing you a multiplier. So this is the impact on an existing mortgage, especially a variable rate adjustable mortgage. So I will show you the next screen, which will basically explain how did we reach today's interest rate, the historical data, and I will do some elaboration on that too. Okay, so here we are. So this is the historical data from May 31st, 2010 actually. So this is roughly 15 years old data starting from that. So left hand side column shows you dates, middle column shows you target overnight rate, which we call as overnight lending rate. And this is not the prime rate. This is totally separate from the prime rate. Prime rate is basically 2.20% higher than this number. So let's say and the change is on the right hand side column, so it shows you all those details right now. So let's jump in. Basically normal pre-COVID times in 2015, January 2015, the target overnight lending rate was 0.75, means Bank of Canada's key lending rate was 0.75. Banks were lending a little bit over 2% at that time, so the banks were 2.75-ish. And at that time, let's jump to the yellow highlighted ones. COVID time, March 3rd, 12th March, 26th of March, Bank of Canada basically had to drastically cut those interest rates by 50 basis points each time to lower the impact of everything that was happening at the COVID time. But after COVID, right after COVID, you can notice that March 22nd is 2022 actually is the date when they started increasing their interest rates. Even though many economists were asking them to increase the interest rates gradually, so there's less impact on households with increase in the monthly payments and all that stuff, nobody listened. I would say Bank of Canada took their sweet time and they basically started increasing the interest rates in March 2022. Why they had to increase the interest rate? To curb inflation. The cost of pricing after COVID, post-COVID was going up and up and up and up. Everything, gas, expenses, grocery bills were up and up. So to curb that cost, to bring that cost down, they had to increase those interest rates to slow down the economy and everything. So they should have done it in 2021. They did not. They did it in 2022, 2023, and this was this kind of steep curve going up, not gradual like we go stairs, upstairs, like downstairs gradually. No, it was like boom, like this. And you can see the impact over here. The purple ones, July 22 and September 22, 1% change, 0.75% change. So 100 bips increase and 75 bips increase right in those two dates over there. So that's the reason why these economists were asking the Bank of Canada to do gradual increases. So there's not much impact, but nothing happened. Anyhow, rates go up and up and up till July 2023. And now in June 2024, the green ones, they have started cutting down by 25 cents each time now. So even though yesterday I was predicting on my Facebook account that the Bank of Canada would be cutting down this interest rate by 50 basis points, but they did not. They only cut it by, in the last line, 25 basis point. Whatever it is, we will take it as is, maybe small baby steps. But so this is the historical thing. This is the variable interest rate. The center line, as I said, is the target overnight lending rate, not the prime rate, but add 2.20 to this number becomes the Bank of Canada bank's prime rate, like TD, Scotia, ITB, RBC, you name it. So this is a historical history. Now in the next segment, I'll explain what the difference approximately would be on the prospective buyers. So if you are a prospective home buyer, how does this rate cut help you or impact you? So we have to go back and talk about stress test. So stress test is there. So whatever, let's say you are qualifying for a variable interest rate today at 5.55, the banks will add 2% on top of that, which would be stress test and qualify you based on that. So if yesterday you were doing this qualification and today you are doing this qualification, you will have more buying power. Why? Because that interest rate went down, the qualifying interest rate also went down, so you will have more buying power. Your purchasing power will go up. So how much it will go up? I just did some offline calculations. It will go up by roughly $7,000 to $8,000. Keep in mind, these interest rates that I'm talking about variable, they are insured rates. What it means is CMHC insured mortgages or Genworth insured mortgages. Canada Guarantee's other one. They are basically for the mortgages where your down payment is less than 20%. So 5.55 as of today basically is 6.45 minus 0.90. Some lenders may come with another promotion. Who knows? But right now on an insured mortgage, that's a discount, prevailing discount. So how does it impact fixed mortgages directly? No, it does not. Directly, it does not. The mortgages, fixed mortgages and variable mortgages are not tied up to each other. They follow each other, trending same way, but they're not directly linked to each other. The fixed mortgages are linked to the bond yields, and the variable, as I explained, core inflation, unemployment, many other factors are involved in there, right? So fixed rates will gradually come down, but it may come down tomorrow. Who knows? Lenders comes up with new fiscal ending is coming up. October 31st is fiscal ending for all institutions. Maybe they will come up with more discounts. Who knows? Maybe in the new year. But bottom line, the variable interest rates and fixed rates are going down. If you are looking for a brand new mortgage, I would recommend you to go with the variable. Do not lock yourself into a fixed. But having said that, if you cannot qualify for a variable because the rate is higher, you need more income to qualify, then you don't have any choice. You have to go with a fixed mortgage. But yeah, that's the main synopsis. The rates are coming down. Watch the news. If you have any follow-up questions, feel free to call us, text us, or comment below, and we would be happy to help you out. Thank you very much. Take care.